Welcome, everyone. It is June 12, 2025, and you are tuned in to the 59th episode of Finwell Daily Brief. Get ready, because we're jumping right into the market movements and the financial highlights from today. This is all based on the market closing data. We're going to unpack exactly what happened, look at the key numbers, and figure out why it all matters directly to you.
Definitely a day that needed watching closely. We saw some significant shifts driven by, well, a mix of things happening here at home and internationally. Made for a complex picture, really.
Let's start with that snapshot then. Closing bell today, June 12, 3:30 p.m. India time. It felt like a tough session. Across the main indices, it was red. The Nifty 50, our benchmark, closed at 24,857.70. That's down 283 points odd, 1.13% lower.
And that pressure, it wasn't just the big names. The Nifty Midcap 150, it finished at 21,483. That's a fall of, 363 points, 1.66% down.
Wow.
And the Nifty Small Cap 250 index followed suit, closed at 17,260.19. Down about 269 points, so 1.53% lower.
So large, mid, small caps, all feeling the heat. The Nifty Total Market Index, giving us that wide lens, confirms it. Closed at 12,960.65, down 181 points or 1.38%. Yeah, bears were definitely out today.
That broad decline really tells you the selling wasn't just one sector at first. It was more about the overall feeling in the market. And equities weren't the only story. The bond market, it also sent a signal. The yield on the India 10-year government bond, that saw a noticeable jump.
Right, it hit 6.35% today. Yesterday it was 6.28%. So when that 10-year yield climbs like that, what's the typical read-through for us, the listeners?
Well, a rising bond yield, it generally means lenders want a higher return for loaning money to the government long term. Could be a few reasons. Today, it seems like the market's adjusting after the recent RBI policy, plus reacting to that global uncertainty we're seeing. Higher yields can, make bonds look a bit more attractive compared to stocks, maybe pull some money that way. It could also hint at worries about future inflation or maybe even rate hikes down the line. It's definitely a key signpost for borrowing costs and sentiment.
And it looks like the currency market mirrored some of that uncertainty, too. The rupee weakened against the U.S. dollar.
Correct. Closed at 85.62 rupees per dollar. That's weaker than yesterday's 85.49. The pressure points mentioned were, again, that global risk-off feeling, investors getting cautious, and those rising tensions in the Middle East.
How do we actually feel that, though? A weaker rupee against the dollar, what does it mean for our daily lives or finances?
Yeah, it has a few impacts. For one, imports get more expensive. Think oil, electronics, stuff like that costs more in rupees. Businesses relying on imports might see costs rise and maybe pass that on. So potential inflation there. On the flip side, it can make our exports cheaper for buyers overseas. Good for exporters, potentially. But generally, a sharp weakening like this can signal capital leaving or just more caution. Adds another layer of volatility,
That makes sense. It's definitely a complex picture. Okay, before we get into the weeds on the specific headlines driving this, let's quickly switch gears for our financial fact of the day. This one's actually a bit of good news.
It is, and it's an important underlying trend. India's net household financial savings, they've bounced back quite significantly. Reached 5.1% of gross national disposable income in FY24, the fiscal year just ended.
That's a good recovery from what was called a multi-year low, and I hear economists are actually predicting more improvement.
Yes, the forecasts suggest it could climb higher, maybe hitting around 6.5% in FY25.
Wow, 6.5%. That's quite a projected jump. What's behind this optimism for household savings?
Seem to be two main things: a generally more positive economic outlook, and inflation starting to moderate a bit. When people feel more secure about the economy, their jobs, and their money isn't losing value as fast, they tend to have more room and confidence to save.
So why are these savings numbers so important? For the economy and for us personally?
For the whole economy, household savings are absolutely vital. It's a huge source of domestic capital for investment. Think business expansion, infrastructure projects.
Yeah.
It means less reliance on foreign money. It's like a bedrock indicator of financial health. And for you personally, while it's an average, it suggests households are maybe getting on a stronger footing. Building savings is key for long-term goals, right? Buying a home, retirement, handling emergencies. It's fundamental financial well-being.
That's a really good point. Encouraging to see that number moving up. Okay, let's circle back to the markets and the specific events that really shook things up today and led to those numbers we discussed.
Right. Today's market drop wasn't subtle. It was pretty clearly linked to some major news breaking through the day.
Let's start with what's being called the main catalyst.
Yeah.
Those global tensions combined with that awful Air India incident.
Yeah, this really seemed to set the negative tone. Indian stocks took a sharp dive, as you said, Nifty below 25,000. And the Sensex saw that steep fall, 992 points.
Almost 1,000 points. What were the specific triggers mentioned that caused such a big reaction?
Well, first, escalating tensions in the Middle East. Reports mentioned the U.S. president announcing plans for personnel evacuation, citing concerns about Iran's nuclear program. That kind of geopolitical flare-up always rattles markets' uncertainty about oil, trade, stability.
Right, that global fear factor is always powerful. But then, tragically, a major event here at home added to the pressure.
Yes, and the human cost is paramount here, of course. The second big trigger was the terrible news about the Air India Boeing 787 crash near Ahmedabad.
The details are just harrowing. Air India flight, a 787 Dreamliner, 242 people on board, heading to London, crashed right after takeoff from Ahmedabad.
Reports indicate it happened around 1:38 p.m. local time. Apparently, it failed to gain altitude properly, reached only about 825 feet, and then there's an explosion. Just heartbreaking.
Absolutely devastating. And while the human tragedy is the focus, from a market perspective, this incident hitting amidst already high global tension just amplified the sell-off, didn't it? Added a sudden, severe layer of domestic worry.
Exactly. Markets react very quickly to unexpected high-impact events like this, especially in a major sector like aviation.
Moving to the next news point, we saw a specific stock, Paytm, tumble quite hard.
Yes, Paytm shares dropped over 10% today. The direct cause cited was a clarification from the finance ministry.
And this was about the merchant discount rate, MDR, on UPI transactions.
Precisely. The ministry clarified, no MDR charges on UPI. Now, the twist is, the stock had apparently surged earlier, hit a 3-month high even, based on false reports that MDR might be introduced.
Wow. So it flew up on bad info and then crashed when the real news hit. It really shows the power and the danger of market information or misinformation.
It's a stark reminder, isn't it? How quickly prices react to news, even rumors. Really underscores why you need verified info and need to understand the actual policies.
Okay, news point 4 touches on a trend we've seen resurface, FPI outflows continuing.
That's right, foreign portfolio investors, FPIs, they were net sellers again in the first week of June. The data shows they pulled out rupees 8,749 crore.
Which is a huge swing from May, right? May saw record inflows of nearly 20,000 crore.
A complete U-turn in sentiment compared to last month. And the reasons cited for this selling, pretty much the themes of the day. Global uncertainties, those Middle East tensions again.
And remind us, why is FPI activity something we should keep track of?
Well, FPIs manage huge amounts of capital. Big inflows can lift markets, boost sentiment. Significant outflows, like now, can weigh things down, especially the big liquid stocks and the main indices. Their actions often reflect the global mood towards emerging markets like India.
And finally, news point 5 circles back to the crash impact. Aviation stocks took a hit.
Unsurprisingly, yeah. Shares of Indian Airlines fell after the Air India news. Interglobe Aviation, that's Indigo's parent, dropped 3.44%. SpiceJet fell 1.85%.
I think Boeing shares were also down in U.S. pre-market trading.
Correct. An incident like this sends immediate ripples through the sector. Investors worry about potential regulatory fallout, passenger confidence, operational risks. It's a direct market reaction to a terrible real-world event.
So, wrapping up the news, global tensions, amplified by a tragic domestic crash, a stock swinging wildly on policy news versus rumors, and foreign money heading out. Quite a cocktail causing today's market fall.
A very challenging mix, definitely. Multiple headwinds hitting at once.
Now, before we analyze what this means for your strategy and issue a crucial warning, let's take just a moment. We want to connect with you, our listener, and invite you deeper into the FinWell community. We put together this brief every day to help you cut through the noise, understand what's really moving the financial needle, and stay informed. If you find this valuable, if it helps you make sense of it all, please subscribe to the FinWell Daily Brief. Get these updates daily, right where you need them, and connect with us further. Find SOS FinWell on LinkedIn. Join the conversation, share insights. Let's navigate these markets together. We'd love to have you as part of the community. Okay, let's shift focus now to the IPO market, specifically an SME IPO that closed today, June 12th. Janik Power Cables Ltd.
Right, an SME small and medium enterprise offering. The price band was 100 to 110 rupees per share. They were looking to raise about 51.3 crore rupees in total.
Now, looking at the details, several potential, let's call them red flags, were highlighted. Let's walk through these and explain why they're a concern for anyone thinking about investing.
Absolutely. Got to look under the hood, especially with SMEs. First flag, limited manufacturing experience. Seems the company only started making certain aluminum products specifically since April 2023, so just over a year's experience there.
Why is that a worry for an investor?
Well, a short track record in manufacturing, it just raises questions. Can they operate efficiently long-term? Can they scale up smoothly? There's less history to judge their production reliability compared to established players.
Okay, less proof of consistent execution. What's red flag number 2?
Geographical concentration. All their manufacturing happens in one place. Sonipat in Haryana.
And the risk there.
And that makes them vulnerable. A flood, labor strike, power grid issues, anything specific to that one region could halt their entire production. There's no backup location, no diversification against that kind of local risk.
Makes sense. All eggs in one geographical basket. Red flag number 3.
Raw material volatility. Apparently, they don't have long-term contracts for key stuff they use, like aluminum ingots and litho sheets.
So what's the problem with that?
Without locked-in prices, they're exposed to commodity market swings. If aluminum prices spike, their costs shoot up, hitting profits. Or they have to raise their prices, maybe lose business. Creates uncertainty in costs and supply.
Got it. Okay, and red flag number 4.
Customer concentration. Their income relies heavily on just a few big clients.
So if one big customer walks away or cuts orders, it could really hurt them.
Exactly. It's a business sustainability risk. Losing a major client means a big revenue hit. Their performance is overly dependent on keeping those few relationships happy, rather than having a broad customer base.
And lastly, a point about just getting into the IPO itself.
Yes, the 5th point for many, high minimum investment. For retail investors, the minimum lot size meant putting in over 1.3 lakh rupees.
That does sound pretty steep for an SME IPO.
It is. It's a barrier for smaller retail investors who might want to dip a toe in, but maybe not commit that much, especially in the riskier SME space. It prices some people out.
So you put the growth story. I hear revenue growth was impressive, alongside these significant red flags. What's the bottom line, the critical take here?
Well, yes, reports mention impressive 5x revenue growth. But the analysis strongly concludes that given the limited manufacturing history, the location risk, the raw material exposure, and the client concentration, this looks like a high-risk investment. It was specifically flagged as unsuitable for conservative investors.
That is really crucial perspective for your decision-making. High growth can look tempting, but you absolutely have to understand the underlying risks, especially with SME stocks, which just inherently carry more risk.
Precisely. Informed decisions mean looking past just the headline growth number and weighing these potential vulnerabilities carefully.
All right, let's try and tie all of this together now. The market fall, the news, the FPIs, the currency, into a market outlook and analysis. What does this actually mean for you, the listener, and your approach right now?
Well, given today's sharp sell-off, clearly pushed by that mix of global tension, the terrible Air India crash, and Nifty slipping below 25K, the market's signaling caution, high uncertainty.
So the key themes are definitely that volatility from the Middle East, the specific worries around aviation, and the continued FPI selling. In this kind of environment, what's the suggested strategy?
The recommendation coming through is basically play defense. Focus on quality large-cap stocks. They tend to hold up better in storms. Avoid leverage, especially in mid-caps, which can swing more wildly. And, importantly, keep some cash ready. Maintain cash reserves.
Why is holding cash, keeping some powder dry, so important when things feel this shaky?
Cash gives you flexibility and stability. If the market's choppy, having cash means you're not forced to sell things at bad prices if you suddenly need money. Plus, it puts you in a position to maybe grab opportunities if the market dips further. Buy quality names cheaper, perhaps. It's really about having options in uncertain times.
And the weakening rupee, how does that fit into the outlook?
Like we touched on, a weaker rupee means pricier imports. That adds inflationary pressure. And that could tie the RBI's hands a bit, right? Makes it harder for them to consider cutting interest rates or easing policy if inflation is a concern.
Finally, you mentioned a specific technical level for the Nifty being watched.
Yes, 24,850 on the Nifty. That's seen as a key support level. If the Nifty breaks decisively below that, technical watchers might see it as a sign of further potential falls, maybe down towards 24,700 next. These levels often influence short-term trading.
So the message is clear. Caution, quality, keep some cash flexible, and be aware of those technical markers.
Exactly. Discipline, focus on fundamentals, managing risk, that's paramount right now.
Speaking of managing risk and being watchful, there's a shady market practice we should all be aware of, especially retail investors. It's called circular trading.
Yes, circular trading. It's basically a way to manipulate the market, creating a false picture of activity and price.
How does it actually work? What do they do?
Typically, it involves a group. Could be individuals, could be companies working together. They basically just buy and sell shares of a stock back and forth among themselves, often at prices they've already agreed on.
So they're just passing shares around in a closed loop.
Pretty much. They're not really trading with the open market. The whole point isn't genuine investment. It's to pump up the trading volume artificially and maybe nudge the price up too.
And that's where the danger comes in for us, the retail investors.
Absolutely. Because it creates false signals. It looks like there's lots of interest, lots of buying and selling. Maybe the price is rising, makes it seem like a hot stock with real demand. You might see this, think something's happening, and jump in buying the stock based on this illusion.
And then you could get stuck when they stop.
Exactly. Once the manipulators stop their circular trading, that fake volume dries up instantly. The price support vanishes. The stock can just collapse. And you might find it really hard to sell without taking a big loss, because the real demand you thought was there, it just wasn't real.
That sounds incredibly risky. What can listeners actually do to avoid getting caught in something like this?
Be suspicious. Watch out for sudden huge spikes in trading volume in a stock, especially if there's no real news about the company to explain it. A massive jump in activity for no apparent reason, that's a potential red flag. Also, before trading, especially smaller stocks, try to get a sense of the real liquidity. Can you actually buy or sell a decent amount without moving the price drastically? If the volume looks weirdly high, but liquidity feels thin just below the surface, be very careful. Awareness and checking are your best defenses here.
That is incredibly important advice. Watch for volume spikes without news. Question it. Check liquidity. Awareness is key protection for your money.
It really is.
Okay, as we wrap up this FinWell Daily Brief, let's quickly summarize today. Indian markets took a significant hit, driven hard by that double whammy of global tensions and the tragic Air India crash. Add rising bond yields and ongoing FBI outflows, and you get a very cautious market mood.
Today really highlighted how interconnected everything is: global events, local tragedies, market sentiment. It stresses the need for investors like you to stay informed, stay disciplined, and be wary of both big-picture risks and shady tactics.
Couldn't agree more. In this climate, caution, quality, and vigilance are your watchwords. To stay updated daily, please subscribe to the FinWell Daily Brief, and to connect with fellow investors, find SOS FinWell on LinkedIn.
And maybe a final thought for today, a classic from Warren Buffett. The most important quality from an investor is temperament, not intellect.
So true. How you react often matters more than just what you know. Thanks so much for joining us today.
Thank you.
Stay informed and invest wisely.
Disclaimer: this report is for informational purposes only. Market data is sourced from SEBI-registered exchanges and regulatory filings. Consult a certified financial advisor before making investment decisions.